Dollarama stock has been in the red of late. It has come down off highs of more than $190, and it recently reported earnings, which haven't given it much of a boost. What's the story behind the stock right now? How did it do on earnings? Why isn't it rising? And is it worth buying today? Let's find out. On August 27th, the dollar store chain posted its second quarter earnings. It was a good performance for the company as sales of $1.7 billion were up 10.3% year over year. For investors, the key percentage to focus on, however, is the comparable store sales growth. That tells you how much growth it achieved when only looking at stores that were open a year ago. Effectively, it excludes new stores and any that it may have closed recently, giving you an apples-to-apples comparison. Dollarama's same-store sales growth for the quarter was 4.9%, which it says was higher than the 4.7% growth it reported a year ago. That was a solid growth on the top line, and on the bottom line, its numbers also looked good. Net earnings were up by more than 12% to $321.5 million. As consumers look for more cost savings at their local dollar stores, Dollarama's business could continue to do well. In the US, for example, Dollar Tree has been benefiting from higher income shoppers at its stores. Walmart is also seeing people with higher household incomes spend at its stores for the sake of finding ways to save money amid some challenging economic conditions. Dollarama is likely in the same boat, and so it's little surprise that it's also doing well right now. What's most promising, however, is that Dollarama's growth opportunities stretch beyond just Canada. Recently, it closed its acquisition of the Reject Shop, which is the largest discount retailer in Australia. It's a huge growth opportunity for the business, and it also opened its first Dollar City location in Mexico. Meanwhile, it's still opening more stores throughout Canada. Dollarama has been a phenomenal growth-oriented business to invest in, and as well as it's done and as much as it's grown already, it can still get a whole lot bigger in the future, particularly as it expands into new markets like Australia and Mexico. What may have been a bit disappointing, however, is that the company's guidance calls for comparable store sales growth to be in the range of 3 to 4% for the full fiscal year, which means that the company is bracing for a bit of a slowdown in upcoming quarters. That's not great news, and it can explain why investors weren't buying up the stock after it reported earnings. On August 26th, the day before earnings, the stock closed at $192. As of Thursday, it was trading at around $189. By no means is this a huge sell-off, but it does suggest a bit of resistance from investors to pay more of a premium for the stock. And make no mistake, Dollarama is trading at a premium. Its price-to-earnings ratio is 41, which is high for a business such as this, and one that's expecting its same-store growth rate to be in the single digits, perhaps as low as 3% for the full year. And at the same time, expansion efforts into new markets may be costly and lead to lower profits in the future. There's a lot of things to consider. Shares of Dollarama have dipped below their 50-day moving average, but the 50-day moving average is still well above the longer 200-day moving average. There aren't any significant bearish technical indicators going off here to suggest that the stock is going to crash, but the one thing to watch out for is whether it continues to show resistance at around the $190 mark. It has gone above it, but not for long stretches, and with it hovering around there, it could be a sign that investors are being a bit more cautious with the stock of late. Dollarama does have some great growth potential, but when you're paying more than 40 times earnings for it, you're effectively paying for a lot of that future growth already. It's baked into the valuation. That can mean limited returns if you buy when it's priced this high. This has been a terrific growth stock to own, and over 5 years, it's up over 280%. It's hard to go wrong with Dollarama if your plan is to hold on for the long haul inside of a TFSA. But with its valuation being as high as it is right now, I think there are better growth stocks to consider, ones which may have more upside both in the short term and the long term. So what do you think about Dollarama and its latest earnings numbers? Is it a good buy? Let me know in the comments. And be sure to like and subscribe for more of these types of videos in the future. Thanks for watching.